Good morning. This is Bakes, Kevin Baker with Bakes Takes. Welcome to the podcast. This is for the week ending Sunday, August 16th. Let's get right into it. Number one, the nuclear winter of the 60-40 portfolio. Extreme, but I think is valid. Bond prices are going down. Am I being vague? Say it ain't so. No football. I'm getting nervous, but I'm glad I own esports stocks. That might be coming to the rescue. And I've seen anecdotes of it becoming a D1 sport. So it's becoming real. And thank you, John, James, Murph, Charlie, for your questions. I love it. But ladies, can you please pick up the pace? I'd love to hear from you and see what you want me to talk about. So it isn't just a guy's show. Anyway, here we go. Mike, my son Jack was here last week. Thank you for your extra work, having the two of us.
Great show.
I love the kid. I miss him. He's in New Jersey right now at UBS, and it's too quiet in the house. I'm officially an empty nester. We're officially empty nesters. And frankly, it bummed me out last week. So I wasn't my usual jovial self. Yeah. But anyway, he's doing a great job of promoting the show. I also want to thank Samuel M. from Chicago, Barry P., Daryl C. from Pennsylvania for subscribing to my YouTube channel. Also do me a favor. I'd love to hear your voice asking the questions live. So if you could tape your questions on your voice memo app and email them to bakes at bakestakespodcast.com, I think it'd be kind of a cool addition to the show.
That would be.
Anyway, this is Jon C. from Pennsylvania, old friend of Jack's, and asking about S&P resistance. And poor Mike has heard this so many times, but he's going to hear it for the 40th time. The charts up here, 338 is the SPY resistance. That's the ETF that represents the S&P 500, also known as the SPX. 3380 is obviously the multiple of what the SPX is. It's wedging up. Volume is receding overall. The down day volume is greater than the up volume. Are you sick of this yet, Mike? Okay, yes, you are, but that's okay. And John's asking about, what does it mean about the S&P, retracing everything and what have you. I think CNBC is playing this up too much, in my opinion, and here's why. The bottom line is that if you own the SPY at the beginning of the year, you're up 5%. It's okay. It's especially since we've been going through a pandemic, but it's 5%. I mean, that doesn't get me going that much, and there's a bunch of reasons for that we'll get into about the big guys leading the charge to the upside. But I'm watching this intensely. It's more if and how we hit new highs rather than do we hit new highs. What's the volume? Is there follow through on the ensuing days? Is it I think the closing at new highs is way more important than an intraday new high, for example. I promise to keep you in the loop. The market seems tired to me, and I'm going to stick with Sue, my wife, and also my acronym for the portfolio, Silver, Uranium, and Esports, which is working pretty well so far. This goes into some other questions that have come up, but I put it here. The S&P 500 is really concentrated in the five biggest stocks: Microsoft, Apple, Amazon, Alphabet, and Facebook, more so than the prior extreme in March of 2000. I'm just one of the things I'm dazzled by is Microsoft being the only name that's still here after 20 years. I just think that's incredible. And but so you have the generals that are doing really well, and I think the corporals and privates are not doing very well. And to have 21, 22, 23% of the S&P index in five stocks is things have to keep going right for them, and we'll see if that happens. John, you asked if I worry. I don't worry because I have the scars, I have a plan, and I have a sell discipline, which I've gone into the past, and I'm happy to do so in the future because I don't want to lose a lot of money. I'm not going to ride anything down 80% percent like is what happened in the prior times with the tech stocks when we were here. I just won't do it. I will just be unemotional, and I will old yellow them, and I will cut them. You like the Old Yeller reference?
I did, yeah.
And just for you youngsters out there, it's an old Disney movie, and Old Yeller is...
Spoiler alert.
Oh, sorry. Spoiler alert. Good call. Old Yeller, great dog, and he's wonderful, but then he becomes rabid, and Timmy, whatever the hell his name is, has to go out and shoot him. Those are stocks. Stocks are great when they're in your lap and bouncing around, and it's great. But then if they start foaming at the mouth, you have to take them out. And that's a graphic description, but I hope this helps. And please respond if I need to expand or clarify. And PETA, I'm just, Disney made the movie. It was years ago. I had nothing to do. No animals were harmed in the making of this podcast.
Yeah.
Charlie S. from Pennsylvania said, this is great. I just copied the damn things. I like it so much. An email. Thanks for another great episode. Bakes, thanks for another great episode and nice guitar skills. Which I play guitar, as you probably have learned. Some fat guy got in and took over my guitar equipment in the basement. My son taped me. Mike and I really couldn't find music that we really liked for the intro and the outro for the show, so I made one up. And I played it, and it's on there, and I'm not the best guitar player in the world, but I have fun with it, and if only my son Jack was as talented as me, that's maybe something to that. He has a couple of questions. Okay, what are your views on SPACs and their recent popularity success? And I won't read all this, but what do you think of the U.S. dollar losing its dominance as a reserve currency? He says, thanks a lot. I'm a big fan. Look forward to the Bakes Takes website. That's my bad, Michael. Get on that. Have a great weekend. All the best, Charlie. And SPACs would go up to one chart if you don't mind. Oh, that's great. Thanks. And this is from 2 weeks ago, Mike. And it's I love the interactive nature of this, where we have feedback loops now with our fans, and it's good for me, and I hope for everybody. SPAC activity has reached all-time highs. And that's from the July 25 show, this chart that came from Renaissance Capital. And I'm just going to point out, the last time it peaked was in 2007. That matches a stock market peak. And the low was 0 SPACs in the market low of 2009. Here we are at 59 and counting, and we're at a stock market high. So past doesn't have to be prologue, but it isn't bullish. It just flat out isn't. And Barron's had a cover story that we've talked about before with Bill Ackman raising $4 billion in a SPAC, and it just feels really frothy to me. So I don't own them. I'm not interested in them. I think they're a contrary indicator. If they're popular, I want to start fading stocks, and it just doesn't bode well for me. So, and this chart, I think, speaks for itself. Dollar is a reserve currency. I'm not a big macroeconomic guy because there isn't a way to make money from it, which is what really interests me. But you asked the question, so I'll give you my thoughts. I don't think the dollar is going to lose its reserve currency status anytime soon. Certainly not to a fiat currency, okay, one that's basically printed by governments. Which one would you take? Would you take the euro? I wouldn't. Would you take the Chinese yuan? I wouldn't. So the dollar, as imperfect as it is still the reserve currency used to settle oil, gold, and so much of international trade. Okay? Now, a podcast that for the life of me I couldn't find, but came up with a fascinating thought. Obviously, crypto is viewed as a potential replacement or augmentation of traditional fiat currencies that governments print. And Bitcoin went through 12,000 yesterday, for example. And this fellow, and I can't remember who it was. So if you've seen the podcast or heard the podcast, let me know. But he suggested an Amazon cryptocurrency.
Wow.
And you think about it, and it's 60% of Americans. I think I have this number right. This is from my feeble memory, so bear with me. But 60% of Americans have a Prime account, and I would argue that they're more trusted than Facebook. And Facebook's current, crypto was blasted when they proposed it. Amazon, maybe not so much. They haven't proposed it. I haven't even heard a rumor about it. It was just a podcast suggestion. And so I think if the dollar has its reserve currency status threatened, it's probably going to be from some sort of a cryptocurrency. So there you go. But again, I can't
have Bezos' face on it on the coin.
I don't. Yeah, maybe. So I put that out there for what it's worth. Thanks for the question. I hope I've been helpful. Let me know if I haven't. James V came back from Pennsylvania and asked about Bill ONeil. I've talked about his books in the past, and I've been a client of William ONeil since '94, I believe. I've used the Big Daily Graphs books. I've used Wanda. I use Market Smith now. I'm a huge fan. The charts that you see here are from Market Smith, so they're not paying me to say that. I just like it. And he asked about Bill's dismissal, I think that was the term he used, of high PEs being a problem. And here's the context. I mean, his can slim methodology works for many people. It's also known as momentum. It works until it doesn't. So can slim is current earnings, annual earnings, something new going on, new product, new service, new highs in his case, a low number of shares outstanding, leadership in a particular industry, institutional sponsorship, growing institutional sponsorship, and the market overall. Can slim. Not the most elegant acronym I've ever heard, but it's one that I remember after all these years. And he also used the analogy of he's an LA-based money manager, hearing that Wilshire Boulevard properties were expensive. But then they were more expensive 10 years after that, and 10 years after that, and 10 years after that. And so paying up for quality, I think, was what he was saying. And again, I think momentum does work until it doesn't, which is why you have to have a sell discipline. And high valuations are warranted when there are moats, competitive barriers that protect the business. The folks at Morningstar, I think, would certainly back this up. I think Warren Buffett would certainly back this up. So high multiples can stay high and expand much longer than you think they can. So, and value managers are getting crushed by growth managers over the last 10 years. So that's the perspective that I bring to the table. Shorts are kerosene, meaning that if there's a high short interest, you could say all day long that stock is overvalued. Let's take Tesla. If you've been short Tesla, you've had your head handed to you. I mean, 400 to 1,700 in a year. That's a painful place to be. So someone who says Tesla's overvalued, the market doesn't care. They said you're wrong, and they ripped your face off. So there you go. And I go, my great friend Mike DiCarlo, worked with him back in the 90s, and he saw the internet much more clearly than virtually anybody, in my opinion. And we owned, in the special equities fund at John Hancock, America Online, AOL, and Netscape up to our eyeballs. I mean, I think we were the number one holders, and people thought those were expensive, and boy, they got more expensive right in the face of everything. Even when the accounting issues came up and controversies, the stocks just worked. So valuation is in the eye of the beholder, and I wouldn't, if you eliminate higher PE stocks entirely all the time, there's going to be a lot of years where you're not doing much of anything. All right, here's another one. This is from Murph, and I'm going to give you my caveats ahead of time. He asked, what advice would you have as these recent college graduates, like my son and Murph, are getting these benefit packages? What would you do in terms of saving, investing, spending, etc.? All right, my caveat is, I've done this well at times, and I've done this horribly at times. So I am no angel, and so this is the ideal. But especially, you don't have a wife, you don't have kids, this is the time to plan accordingly. To keep it simple, Murph, I would say live below your means and pay yourself first. Now, that sounds really simple, but life happens, and there are times when jobs go away, industries go away, and times get tough. And I hope that doesn't happen to you. But again, I'd like to have you expect the best, prepare for the worst. So here's my general thoughts, okay? Have a month of expenses in cash sitting in an account, frankly, that you can't access with an ATM card. That would be my idea. 401k, I would max that out as best you can. And certainly max out the match that your company offers to add to the 401k, because you keep money away from taxes. And that's huge. I mean, let's say your tax rate is 30%, give or take. Keeping that 30% in your account versus giving it to the government over the course of the next 40, 50, 60 years in your case, huge. Absolutely huge. I would have half in some sort of an S&P-like vehicle, and half in a rest of world vehicle. Now, most of the time, the menu of options that they offer in 401ks is pretty run of the mill, because they don't want to have it's covering their tail to an extent. They're pretty bland offerings usually, but it doesn't matter. If you compound that over time in a tax-free vehicle, and certainly with them matching it, that builds up monstrously over the course of time. So that would be my general thoughts there. Pay off debts, especially student loans, because the credit hit if you're late on student loans is monstrous. Then I would build 3 to 6 months of an emergency fund, so when COVID happens, you have some breathing room. Then I'd invest in an incremental tax advantage account, a Roth IRA perhaps, and then I'd invest more. And that's frankly, I think, where we come in, is you have your base in your low cost S&P or rest of world index fund, and then we are on the side where we are opportunistic, finding things like silver, like uranium, like esports that is far from run of the mill, but offers, I think, outsized returns over time. And also have fun. Some of these people don't go to Starbucks and enjoy your life. So, but pay yourself first. But I want to make sure you have fun, and I hope that's helpful. So you tell me if it is or if it isn't. Here's in my next segment, big stakes. Bonds are going down, and I know I'm pounding this home, but I believe this fervently, and I see this in a lot of places, and I'm not really looking for it. I mean, it's showing up. This is from Macro Voices, great podcast. Eric Townsend, Patrick Ceresna had a guest, Vincent Duyard from StoneX, and from minutes 13 to 39, he goes through his thesis. I won't go through everything here, but the bottom line is that the FANG stocks cannot grow into their multiples. That's his opinion. He makes a very compelling case. I'll let you be the judge. The 10-year bonds, if they rally by just 6%, they can only rally by 6% if the Fed lowers rates and the 10-year goes to zero. And actually, the Fed can't lower rates much more than they already have. So the upside in bonds is minuscule. And so because of that, the 60-40 portfolio, he calls it the nuclear winter for the 60-40 portfolio. I'm sure that's to garner views. But he has a lot of data here that suggests that the 10% returns you had in this vehicle, in this strategy since 1976, will underperform inflation over the next 10 years. So I think he's right. I think bonds have a tremendous amount of downside, and I think the risk of diversifying some portion away from fixed income is very, very small right now, and the potential preservation of capital is huge. So please check that out. The link's in the notes, and look at the charts that he's supplied here. Reporters of the week, John, this dovetails with your question. These are the folks at The Economist, and points to America's stock markets are flying, its companies still aren't. And it shows that the large companies' earnings estimates have come down somewhat, Mid, less so, and small have come down dramatically, down roughly 55-60%, depending on which stock you're looking at. And then they point to the size of where the gains have come from, and it's basically been Facebook, Apple, Microsoft, Amazon, Alphabet. They're up 35, 36, 37%, depending on the day. The S&P 500 is up 5, like we said, and the S&P 500, when you take out those big five names, is down. So this is a very narrow rally, and God bless you if you're up 30+%. I think very few people are, in my opinion. The pros and the so-called amateurs. They also talk about chief executives in China. 40% see sales getting back to pre-pandemic levels by the end of this year. Only 12% of American bosses do. That makes sense to me. There is no alternative mantra or fear or trend that is out there. I think is going to be met with some pain at some point down the road. So I point you to the article. Take a look at that. This is in Barron's. Randall Forsyth's column talks about golden tips being the best protection for a falling stock market. I won't go through all of this here, but it's the same kind of argument that I've been talking about where, and this is coming from Bob Prince, by the way, who is the co-head of Ray Dalio's Bridgewater Associates, which has used bonds as a hedge against stock portfolio volatility forever. And he's saying what I've been saying, that yields are a little over 50 basis points on 10 years, and there's no room to fall. So there's not going to be much room for total return in bonds, period. And I think he's right, obviously. Keep going down, Mike, please. Yeah, having someone from Bridgewater say this, I think, is pretty interesting, because they've used the bonds as ballast technique and have been very vocal about it for years and years and years. And with real yields down below zero, meaning the nominal rate, the 50 basis points you take out inflation, you're earning negative real returns on fixed income right now, which is why gold is doing so well, because their real return at least is flat. This is something I didn't realize. China's rates are at 3%, so they have room to lower rates where we don't. And I was surprised by that. I thought everybody was at zero, and so the chance that Asia becomes less correlated with the U.S. is interesting. We've talked about China in the past. Some of the charts are intriguing. I haven't pulled the trigger yet, but I'm interested in that. And while the last 40 years has been great for the 60-40 portfolio, here's another source saying that time is over, and tips and gold are better hedges against an equity portfolio. So do with that what you will. Charts and tweets of the week. This is the Apple price to sales ratio. It, again, is blowing through the prior highs, and it's just another sign of how concentrated the stock market has become. It's 7% of the S&P 500. Is a little nuance that if you're a money manager and the S&P is your benchmark, you have to own 6, 7, 8% of Apple, or you're going to get your head kicked in. So, and the automatic buying that happens with the ETFs, topping off and keeping that 7% the same. I don't know what in the world is going to knock Apple off, but it's priced for perfection right now. And I was struck by this mountain of a chart, and again, it goes back years, so it has validity in my opinion. And then here is another perspective that dovetails with some of the other questions we've had from Manish Kata. S&P is at its near its all-time high. The top 7 stocks are $8.2 trillion. The bottom 399 are $8.2 trillion. So those 7 are driving the bus. And don't kid yourself that you're terribly diversified, even in an S&P fund. Even though I think that's a great base, this is where we are right now, and something's going to have to give. So that's what we have. Please subscribe to my Bakes Takes YouTube channel. The audio is the same, but the charts that I reference are on the screen. Follow us on Twitter @BakesTakes_ and other social media. Please use your voice memo app. I know I asked before, but I want to do it again. Tape your questions and email to bakes@bakestakespodcast.com, or write if you prefer. I'll keep you anonymous if you'd like. Thank you for listening. Mike Wilson is my producer. Thank you as always. Have a great week. This is Bakes. And for much-needed levity, this is Lenny Clark. And if you're from Boston, you know Lenny Clark. His accent is epic, even more pronounced than mine. And this is a great link on YouTube. I recommend it. He asked Gronk if he manscapes, what are you, half-dolphin? And then it gets even funnier after that. And again, I want to provide some levity in these very serious times. So that's it. See you soon. Take care now. Bye-bye.